I think the real story is it just adds a little bit more fuel to the bear case on the multinational brands. If you look at the way the brands have traded the last 3 to 6 months, they've meaningfully underperformed the domestic retailers. I think that you already had some concerns around currency, you had some concerns around Europe, which has been negative all year, and from an apparel accessory standpoint, which is really concerning. And now you've got China that just seems to be kind of rolling over a little bit. And it just adds more problems to the multinational brands. And Nike did have some better things to say. I think Adi has done okay there. I think the athletic guys, Lululemon as well, they're actually doing just fine. But if you listen to some of the breadcrumbs the other guys are saying, PVH said some negative.
Is it luxury? Is it as simple as high price and luxury versus mid price and sort of consumer?
Yeah, I would say luxury is kind of a different animal. I would say athletics seems to be the one that's kind of bucking the trend. I think general apparel and casual footwear is starting to slow down. Luxury is really slowing down. Some of that is the macro in the China consumer, but some of that is also just some of the changes the government's making there. Cross-border shopping, Daigou is what they call it, the government crackdown there. Tiffany, for example, they call that a meaningful decline in their Chinese consumer, but it wasn't the mainland China comps, it was their China customer. Remember,
overseas, yeah.
Right, because only 8% of Tiffany's business, for example, is on the mainland, but around 30% of their business is to the Chinese consumer. So they shop.
How do they know that?
You kind of look at the tourism that takes place, the Chinese consumer, credit card data and whatnot, Chinese going to Europe.
Trace the credit card back to a Chinese ad or whatever, so that they know that the sale that was made in L.A. or New York or whatever was made.
Right, so you can track all of that, and there's been a big deceleration in that as of Q3. And you hear this news from Apple, and again, an iPhone is not a diamond ring, but it makes you concerned that things from Q3 that were starting to get bad.
And iPhone's more expensive than a diamond ring these days. But on the issue of China, just last night they cut their reserve requirements and talked about, basically stimulating the economy if needed. It seems like even the Chinese themselves are admitting, yeah, there's a slowdown here.
Look, GDP has slowed. Again, Apple kind of called that out. It's been slowing kind of throughout the last 6 months. It's just concerning for my group because it's not that China is a huge percent of revenue, but especially for the multinational brands, they penetrated the U.S. Then about 5, 6, 7 years ago, they penetrated Europe, and China's been a big opportunity. All the VF Corp, PVH, they've really started to go after China in a bigger way, taking in licenses in-house, and so it's not just a sales slowdown, but profits are tough there to begin with.
So what was so remarkable about Apple's warning was that just in November, they said China was okay, and then all of a sudden, a month plus later, China's not okay. The retailers report a little bit later. So is it possible that we could actually see a turnaround before they close their books on the quarter? I mean, they've got a little bit of time on their side here.
Sure. Look, anything's possible, but I think that what we're talking about is a slippery slope. I think because of that and because of the increased risk you're seeing on the multinational guys, from my conversation with investors, I think that people kind of want to stay safe. They want to look at, okay, well, how do I stay safe in this group? So I want U.S.-centric, defensive, large cap. I want off-price. I want TJ. I want Ross, Burlington. Not my coverage universe, but the discounters, auto parts, dollar stores, safe havens. And that's kind of where I see kind of money flowing around right now in my group.